Today, I'd like to introduce you to the Dynamic Alpha Macro Fund, ticker symbol DYMIX, and more broadly explain what global macro investing is, why it matters for portfolio diversification, and why now may be an especially important time to consider it. Targeting an all-weather investing approach means being prepared, not predicting. The Dynamic Alpha Macro Fund combines a global macro futures strategy with a portfolio of U.S. equities. We apply quantitative, technical, and most uniquely fundamental analysis across U.S. stocks and over 40 liquid global markets, including currencies, bonds, commodities, and equities, creating a portfolio built on multiple return drivers. For investors and advisors, the Dynamic Alpha Macro Fund can serve as an all-weather strategy, focusing on risk management, dynamic alpha generation, and adaptive market positioning with long-short flexibility. As of year-end 2024, the Dynamic Alpha Macro Fund was ranked the #1 fund in Morningstar's macro trading category, recognizing its strong performance within the space. So, what exactly is global macro investing? Let's break it down. Global, because we look for opportunities across the world's major markets, stocks, bonds, commodities, and currencies. But that doesn't mean we invest in everything, everywhere, all at once. We're selective, investing when and where we see strong opportunities. And macro, meaning big picture. We don't focus on picking individual stocks. We focus on the broader forces driving entire markets, like inflation, interest rates, and supply and demand imbalances. This gives us the flexibility to adapt as market conditions change. Now let's talk about why this approach matters. Many portfolios today rely on just stocks and bonds for diversification. Most have seen this type of graph before. The illusion is that a bunch of pretty little colors means diversification. However, over the long term, you really only got two colors. The numbers and shading represent the correlation of each asset class to large-cap U.S. stocks. And in years like 2022, when diversification was needed most, we saw one color as most traditional asset classes moved down together. That's why we've referred to basic asset diversification as providing the illusion of diversification. It looks diversified on paper, but the correlations tell a different story. By adding a strategy like global macro, investors can introduce truly non-correlated sources of return, helping portfolios stay more balanced across a wider range of outcomes, both over the long term as shown here and in years like 2022 when it is needed most. Traditional diversification often relies on stocks and bonds, but these can move together. Global macro introduces non-correlated sources of return, helping portfolios remain balanced across various outcomes. So, we just reviewed why global macro can be a diversifying ingredient in an overall portfolio. But why is now an especially good time? Let's take a look at the relationship between stock valuations and future returns. Each blue dot in this chart represents a point in history for the S&P 500. Going across the bottom, we measure how expensive stocks were at the time, and the vertical axis shows how much they earned over the next 5 years. Notice the clear pattern. When valuations were high, like they are today, future returns tended to be much lower. Right now, the Shiller PE is around 40, one of the highest levels ever, which historically has meant 0% annual returns or worse going forward over a 5-year average. Next, let's look at how global macro has performed. Now, here's where things get interesting. While high stock valuations have historically led to lower S&P 500 returns, the opposite has often been true for global macro strategies. Each purple dot here represents the global macro index, and as you can see, when stock valuations were high, global macro returns tended to be stronger, often above 10% annualized over the next 5 years. This is exactly the environment where diversification beyond traditional equities can really shine. The Dynamic Alpha Macro Fund was designed to blend these two approaches, combining equity exposure with a global macro strategy, targeting a smoother, more all-weather return experience, regardless of equity valuations. Let's take a look at the actual results. The following are performance and statistics as of September 30th, 2025. Worth noting is the year-to-date returns of 22.55% versus the S&P 500 index of 14.83%, as well as the since-inception correlation of 0.26, highlighting the diversification benefits. Lastly, the up-capture ratio of 72% combined with the down-capture of 19% help to illustrate the risk control metrics we implement. Thank you for spending your time with us. We value your interest and invite your questions or feedback. And as always, until next time, take care everyone and make smart, logical, and fact-based financial decisions. Please review this important information for details and visit dynamicalphafunds.com to explore more about the Dynamic Alpha Macro Fund. Discover resources and download the latest fund brochure and important information like the fund prospectus.